In this lesson, we will discuss how companies record fair value adjustments related to their investments under the equity method. So there are further fair value adjustments are required when the purchase price exceeds the book value. Why do we do this? Well, basically we're trying to approximate the effects of a consolidation. The equity method requires that you record the higher expense related to the fair value of the assets. Thus the term amortize the differential. A typical example of this would be under property, plant, and equipment, where you basically would have a higher depreciation expense. So let's look at a fair value adjustment example over the next 3 slides. Let's say we have the purchase price, which includes the PP&E of $1 million at fair value, while the book value was at $800,000. If we assume a 10-year useful life using straight line depreciation, let's now try and figure out how we can amortize this differential between fair value and book value. Continuing on with the example, in this case we take the fair value minus the book value divided by its useful life. So putting numbers to it, it's $1 million of fair value minus $800,000 of book value divided by the 10 years of useful life basically equates to $20,000 a year of a differential. Our required annual adjustment entry here would be a debit to the investment income for $20,000, which is basically an expense, and we would credit or reduce our investment account. It reduces that investment account from our last lesson that we talked about. So as we did before, I'm going to move over to the whiteboard now to review the impact of this amortizing the differential concept on our overall investment. Okay, now let's take our equity example one further step. We've talked about this topic of amortize the differential. What does that really mean? Well, here's our original investment we talked about earlier on the whiteboard. If we now know we have a property, plant, and equipment item that has a fair value of $1 million, but its book value is $800,000, keep in mind this amortize the differential is take that difference of $200,000 over the life of the asset of 10 years, which would be what? $20,000 of amortization per year. How does that affect my overall investment? Well, I have to reduce my investment to $20,000, and that changes my final balance to $2,080,000, which is basically only the $20,000 reduction, and we'll have to do that each of the next 10 years to reflect that amortization of the differential. So that's that confusing term. It basically reduces my investment by that difference of the asset value between book value and fair value. Hopefully the whiteboard discussion helped us better understand the recording of various amortization adjustments under the equity method. So basically the summary of these fair value adjustments are, if you elect the fair value option, it's also available for those investments with significant influence. Keep in mind this decision is irrevocable once it's elected. Thirdly, the equity method investments are still shown on their own line on the balance sheet. They're not lumped with other trading securities. This usually requires a fair value adjustment at the end of each year, such as the $20,000 we just saw in the above example.